Hey, we're Mason and Associates, masonllc.net, masonllc.net. Michael Mason here, certified financial planner, charter life underwriter, chartered financial consultant, over 35 years experience in this business, most of it helping federal employees. We love so much what we do. I'm 61 years old in August. I'll probably be doing this at least another 9 years. The client base we have plans. And when you have a plan, you can go through the tough markets. As we're going to bring Jeff Hybiak in from SEM Wealth Management, I just wanted to tee this up. An interesting number. I went back to 1980. My wife Bobby and I were married in 1981. So I have some perspective when I actually got into the workforce. The Dow Jones was 1,000 points in 1980, and I'm rounding these, so it was like 980, so bear with me. 1,000 points in 1980. It's hovering around 34,000 today. You know, that's a 34 times increase. Put that in comparison to a gallon of gas that was $1.20 in 1980, that's $4.40 today, which is a fourfold, or a median house at $47,200 to one that's $400, which is an eightfold. So your stock market is up 34-fold since 1980. It didn't go straight up, folks. You know, it didn't go straight up. It went up and it went up, and then it came back down, and you had those scary moments. And the one thing we always say in those scary moments when we start to bail is it's different this time. Folks, it's never different this time. As John said earlier, if businesses don't get profitable and America doesn't exist, no matter what your financial plan is, it's not going to work. So with that, I want to bring in Jeff Hybiak, Senior Portfolio Manager at SEM Wealth Management. Jeff, how are you doing?
I'm doing great, Mike. Thanks for having me. And you've definitely covered a lot of things so far in 30 minutes.
So you have a different perspective than we do. We have that direct client interaction. What would you like to tell the folks about what you're seeing? Wait a second, we got John.
Yeah, so I want to hear, Mike, your question, but I also think it's important for our audience to know a little bit about, like, who is Jeff? Why is he here? How do we work together? So the quick 30 seconds on our relationship with Jeff and SEM Wealth Management. We've had a relationship with Jeff for over 11 years now, him, his family, his company, and we are registered investment advisors at Mason Associates. Jeff and SEM are the same. We have a little bit different specialty. So we do the financial planning, we do the cash flow modeling, we do the insurance, the 30-year tax plan, tracking net worth, through our meetings. We wear a lot of hats. Jeff and his team do too, but for us, Jeff serves as our portfolio manager or our sub-advisor, and that he helps us, SEM helps us allocate our clients' accounts appropriately to satisfy the needs of their financial plan. So for example, if Tommy and I are working a financial plan and we need a moderate portfolio, we use SEM. SEM helps us allocate that client to moderate so that their risk and that their portfolio returns are in line with what we're planning for inside of the overall financial plan. So Jeff's our sub-advisor. He's able to really help us construct the portfolio. We live at the macro level where we're saying, okay, what is the total risk that we want to take? What's the return we need? And then we allow Jeff and his team to get more granular. Should we be in small caps or large caps? Should we be in growth or value? How many risky bonds should we own? So we allow Jeff to do that inside of his models, and we manage it from more of like the macro or 30,000 foot level from a risk perspective.
That's a great introduction. And now, Jeff, my question to you is, you've been through this before, and you see your signs. So let's talk about what you're seeing in this market and what kind of peace of mind you may be able to offer to the audience.
Yeah, absolutely. 25 years of doing this. This is SCM's 30th anniversary. So we've seen a lot of things. And the one thing I always remind people about is stocks are a function of overreactions in both directions. And so if you look at right now, a lot of people are focused on year-to-date numbers. So the S&P 500, which is a diversified portfolio, it's the C fund at TSP, it's down about 15% for the year. And everybody says, oh my gosh, that's a big drop. But if you zoom out a little bit, you're basically where you were at a year ago at this time. If even the NASDAQ, which is a 25% drop so far from the highs at the beginning of January, you're still back to where you were at in March of 2021. So really the question is, was what happened in 2021 what should have happened? And I think if people listen to the last two times I was on, and, as John mentioned, we've warned people about this for about a year. And the expectations were we're going to see really strong growth in 2022, and that's why stocks rallied so much in the last part of the year. And then, all of a sudden now we have high inflation and the Federal Reserve raising interest rates. And everybody's in a panic because what they thought was going to happen going into the year isn't happening. And now I wouldn't say they're quite overreacting, but they're kind of resetting prices back to where they're at. Keep in mind over the long term, no matter what 20 or 30-year period you look at, stocks average about 10% per year, give or take a couple percent. I looked today, if you go back to February 2020, so this is just before the whole world imploded for 6 weeks, you're still up 20% from that day if you're in the C fund or the S&P 500. And if you're in the NASDAQ, you're actually up 31% from the pre-COVID number. You simply divide it by 2 and you're right at the long-term average. So stocks overreacted going up. They may be overreacting going down. But if you're in a diversified portfolio, there really shouldn't be any reason to jump to conclusions. There's a lot of reasons this can keep going down. And even if it were to keep going down, it's very unlikely we're going to give back everything that we made off the bottom from March 2020 because, as John mentioned and you mentioned how different your business is. And a lot of businesses are able to function differently than they did during the last recession. So I think it's just something, as John mentioned, we tend to spend what's in our checking account. We also tend to look at our investment balance and we put that in our head as that's the value of our account. And it's really not. The value only matters when you need to start taking money out of there and start living on that money. And if you're still working, you're not to that point yet.
Well, Jeff, I think a lot of good points there. And one of the things that, for our listeners is that, whether you believe in like a bucket strategy or you believe in having everything invested in a similar fashion, if you have a short-term need, meaning your children's going to college in a year, the allocation for your 529 where you have a 4 or 5 year spending plan is much, much different than the allocation of an IRA or Roth IRA that's going to be invested for 30 or 40 years. So we don't want to get into a trap where we're saying, if you have short-term needs, this isn't the market for you. But we should have realized this before the drop that if you have an immediate need to distribute all of those funds in a short time horizon, you should not have been 100% stocks. You should not be exposed to this risk to begin with. So a couple things that I thought was pretty interesting that you sparked in me, Jeff, was investors and clients typically remember the highest day they ever saw. But compound interest cuts both ways and market returns cut both ways. So we didn't get here without volatility up, which means we could not have been here had we not been able to accept some downward volatility from time to time as well. So 2 questions for you is, 1, how long is an average bear market? And I know that's a little bit dicey because we can look at that 2 ways. But then subjectively, I think at Mason Associates, along with your help, we feel that bonds have really been beaten down this year. Interest rates have risen from like 1.5% to 3% on the 10-year. I personally don't feel like we're going to see rates rise from 3 to 6. Okay, so I think bonds are going to start being a little more shelter in a portfolio. There's a lot of people out there saying you should never own fixed income. You should only own dividend-paying stocks. I know that's not something we agree here at Mason Associates. We think bonds provide stability and provide that shock absorber that we need in times of need.
Yeah, 2 really good questions. The first one, I tend to focus more on what I call a recessionary bear market, and that's a bear market that coincides with an actual economic recession, which by definition is 2 quarters of a drop in economic output or GDP on average. And this is the reason I say have a range is because it depends on if you include the 1920s and a couple of the really ugly ones in the 1970s. But on average, you look at a 35 to 50% drop in the stock market during a recessionary bear market, and it takes about 18 to 24 months. So if you look at where we're at now and say, let's say it started at the beginning of January, we're already 4.5 months in. So maybe if you're at the low end of that, you're already only going to have a year left. And I know it only sounds, kind of nonchalant, but in the whole scheme of things, that's not that much longer. And we're already 15 of the 35% down of the lower end of the range. So that's in the stock market. But most people, as you mentioned, if they're getting ready to take an income or getting ready to retire, they shouldn't have all their money in the stock market anyway, which leads to your second question about bonds. And, absolutely. I think what is hurting people, especially when they open their statements or log into their accounts, it's this shock. It's the first time since 1994 where we've seen stocks and bonds go up and down in value pretty much every day together. And so the overall bond market, which would be the F fund and TSP, is down 10 to 10.5% for the year. And that's not much less than the 15% stocks are down. I truly do believe, and again, we don't invest based on my opinion, but the free market has raised interest rates so much. They've done a lot of the Fed's job for them. And people need to understand that the Federal Reserve controls short-term interest rates, and they just now finally started raising interest rates. They've gone up 0.75% over the last couple of months. The free market sets rates based on what's happening in the economy, and the free bond market has said, starting in December 6th, said, oh, shoot, inflation is running really hot. We need to calm things down, or this is going to be really bad for our bond investments. So they started charging higher interest rates. We've seen the 10-year bond go from 1.35% on December 6th all the way up to 3% today. I don't want people to take this as advice to jump in and buy bonds, but specific bonds are beginning to look attractive. We're beginning to see opportunities. I don't know when those will be. If it's a typical recession, and again, I'm not saying we're heading to one just yet, that'll be somewhere halfway into that recession where all of a sudden bonds start to be really great. And in fact, some subsets of the bond market can give you stock-like returns coming out of it, which is how we have the Mason portfolio structured. We're ready to pounce on it. While right now we just sit in cash and other low-risk income investments.
Hey, Jeff, we're going to take our last break of the evening. Stay with us. When we come back, we want to talk about, controlling the things we can control, because what you've said a lot of is this is what we believe and this is what has happened, but we really never know when that bottom is until it's happened, and we're probably 5 months into the bull market. So let's come back. We'll talk about controlling the things we can control. You'll add some spice to that. We'll be right back after the break. All right, you're back with Mason and Associates, MasonLLC.net, MasonLLC.net. We've got a guest on tonight, Jeff Hybiak, SEM Wealth Management. This segment, we're just kind of bang off each other. You've worked with us for over 11 years. One of the things that we say constantly is you have to understand whether you have a wealth manager or a financial planner on your side. Wealth managers are just managing your money, and nobody has a crystal ball that knows when to get out at the top, when to get back in at the bottom. So our favorite saying is control the things we can control. So we're going to see some things happen this year, just like we saw in 2020. We're going to see some opportunities to take some tax loss harvesting on non-qualified accounts. And that just means if you've got the loss and you know it, let's take it and then buy a similar asset. So we're not getting out of the market. We're just booking a loss for future. We're doing things like I bonds that are currently 9.6, aren't they, John, for the next 6 months? We've never talked about inflation bonds before. We're talking about delaying Social Security, as we always do, because that's a guaranteed, 8% increase from 67 for most folks to age 70. And then some of the other things, John, I'm drawing a mental blank. Anything else you can add to that equation?
Well, I think just in general, having a financial plan and having already knowing what your action is going to be when this happens, right? So for 11 years, I've been educating clients that the market is going to go down at some point, and this is how we're going to respond to it. This is why we have bonds. This is why we have cash. This is why we have guaranteed income. So hopefully, when our clients are listening to this show and part of our strategic planning meetings, they're like, this was expected. These things happen. It's not the first time we've been through it. That doesn't mean it's not significant. That doesn't mean it doesn't hurt. We just know that we have to live through these events because over time, like Jeff mentioned on the previous segment, the market goes up more than it goes down. I think 70% of the time, the market's positive. So eventually there will be some negatives, but where else are you going to make 8, 9, 10% compounded interest over 2, 3, and 4 decades? We're not going to make that in I bonds. We're not going to make that sitting in cash. And I would just suggest to our audience that there's a lot of people out there, whether they call themselves wealth managers or whatever, that aren't doing comprehensive financial planning. They're just investing your money. And they'll tell you that bonds are dead. They'll tell you that alternatives are the way to go, or you should only be in annuities. There's a place for every investment. We personally believe that we like to keep our accounts liquid. We like to keep expenses low. We like to own a mixture of stocks and bonds, and we don't own anything that's non-traded, and we don't do alternative investments because we want to have that liquidity. So we don't believe bonds are dead. Even though we may be in a rising rate environment, that doesn't mean bonds don't have a place in your portfolio. So Jeff, we've got a few more minutes here. Can you just maybe shed a little bit of light on some of the moves that we've made in the Mason portfolios that we've been able to reduce some risk, we've been able to take advantage of a few opportunities, and for our audience to know this is not strategies where we're trying to time the market, get out at the top, get in at the bottom, but we are able to make some prudent changes along the way.
Yeah, and I'll just start with that by saying, we are seeing a lot of scare tactics out there. You mentioned them. We may have also heard some ads even, before the show started. These scare tactics, I told people, if you had a normal textbook and you said, during inflation, you want to buy gold, you want to be short the dollar, and you should own Treasury inflation-protected securities, which are called TIPS. You could have been completely right about inflation, and you would be down almost as much as the stock market, if not more. Gold is down 12% since last fall. The U.S. dollar is about the only asset class that's still up. It's up 15% year to date, which just blows my mind. And TIPS are down 7%. So these textbook things that you hear on TV and from other people, they're just wrong. And what we do is we follow the data. We mentioned this last time I was on the show. End of January, first week of February, our lowest risk investment, which I think are in every Mason portfolio. We already took most risk off the table, and we've been sitting in money markets or short-term bond funds since that time. Even our longer-term stuff since the middle of March, they've taken some money off the table. We've reduced our exposure to the bond market, and now we're just watching the data to say, when is the best time to get back in? There's something called duration, which is the measure of how much exposure you have to interest rates. Even our longer-term bond investments have had a much lower duration, so they've had much less volatility than somebody who's just doing a buy-and-hold investment path. And like I said, we're just sitting and waiting for opportunities. I've equated it to, for the money that matters, where we need to protect it, we're sitting in a bunker, we're ready for the storm, we have plenty of food and water, and once the storm passes, we're ready to get out there and just go out living again and know that if people panic, there's going to be even greater opportunities for us coming out of it.
And to be clear, for most of our clients and for our listeners, everything that Jeff said, spot on. Remember, not only do you have your cash, not only do you have your I-bonds, not only do you have your bonds, you have all of that great guaranteed income that's satisfying most of, if not all of, your have-tos in your life. We don't believe that we're going to need to adjust spending, but that's why we do comprehensive reviews with our clients and monitor these financial plans so that if we do need to course correct, we can. But in our opinion, nothing has happened yet this year that would warrant that.
And guys, I've had 80 of what will be 100, and again, rounding, 80 of what would be 100 strategic planning meetings, and our song is accurate. You'll rest easy once your plan is done, because I can tell you maybe 4 or 5 people have had questions about where the market's going. The rest of them realize the following, which is what I opened up with early. Your home is in a bull market. Your pensions are in a bull market. You're going through what may be a bear market. It's not a bear market until it's down 20%. So everything is in a bull. 2 of the 3 things are in a bull market. I want to thank you, Jeff, for being part of this, for being part of our family, all the time.
Absolutely. I love it. And, I appreciate all the trust you guys have placed in us.
MasonLLC.net. MasonLLC.net will be back in 2 weeks.